Okay, so I'm so lucky to be here with Monica Jones, and she very graciously offered to meet, and because I had met her at a real estate class in Walnut Creek, where she was one of the sponsors there for the event. And just as you noticed from the previous video, she was so clear about the different points at which she does, and so I was just taken so strongly by how clear you are, and typically that's really helpful for the client, because then you can explain things in a way that they understand. So you'd mentioned three different things that three different approaches, or I don't know exactly how to say it, but you're a direct lender.
Yes.
And so explain a little more in detail what that means.
So what that means is we actually underwrite for Fannie Mae, Freddie Mac, for HUD, right, for FHA and VA loans, and we service those loans. So not only will we underwrite them in-house, approve them, we fund the loan, and then also we service the loan. So when the client makes their payment, they're making their payments to us. So we keep the loan on the books. The nice thing about being a direct lender is that we do not have any overlays. And what that means is we follow the HUD, FHA, VA, and Fannie and Freddie guidelines without making them more conservative. So there are a lot of lenders out there who underwrite for Fannie, Freddie, FHA, and VA, but they have their what's called overlays to make the guidelines a little bit more conservative. So that's why you'll notice.
We gotta wait. Well, you were talking about being a direct lender.
Yeah, so when you're a direct lender, we choose not to have any overlays. So we follow the guidelines to the T, whereas some lenders, based on their comfort level, will make the guidelines more conservative. So for instance, FHA only requires a 580 credit score with a 3.5% down payment. Or if you have a 10% down payment, you can actually have a score as low as 500. Whereas some lenders might require a 620.
No, that's FHA, you said?
That's FHA.
FHA.
Yep. But some lenders, that might be too aggressive of a guideline, so they may require a 620 or a 640 credit score. And that's why one lender may tell you no, and another lender may tell you yes and be able to help you get approved.
I see. So each lender has particular criteria that they feel comfortable with in lending out their money to somebody, because they want to make sure that that person is successful.
Yes.
And they're also successful. They want their money back.
Yes.
They want the payments on time, but they also want that person to be successful,
because
it's kind of a nightmare to have to like foreclose.
Oh yeah. Banks don't make loans with the intention of foreclosing, right? And in today's market, lenders have to document truly the ability to repay. So all of the income has to be verified, the down payment, your credit history. The loan has to make sense, and you have to show that you've got the ability to repay this mortgage.
And so where does all the documentation have to be given to? Is that to the underwriter, or are there federal agencies that are looking at it also, or exactly?
So what happens is the clients will give us their documentation, I'll review it, analyze it, and that's when I'm determining what the best loan options are for the client, what they qualify for, what we can get them approved up to, and also based on what their comfortable monthly budget is, it might be a different price range than what they're, sometimes people can qualify for a certain amount, but they want a payment at a different amount. So we explore all of those options. Once we go over the numbers, figure out what the client's comfortable with, we then submit their loan to the bank. So the underwriter is, again, a second set of eyes reviewing all the documentation. And then ultimately, once the loan is funded, either we'll keep the loan on our books as a direct lender, or we may sell the loan to one of the other, many banks that we underwrite for.
I see. Okay. So that's the direct lender. And a lot of people, I think when they hear the word underwrite, it's kind of confusing. Is this... And so what does that mean exactly?
Well, what it means is the underwriter is the person who is saying, yes, we are going to fund this loan. Yes, you qualify. It's the final stop. It's kind of the final stamp on your passport saying, yes, your loan is good to go. I think one of the things that we do up front, because we are a very purchase-focused company, is we get the full underwrite up front. A lot of times companies don't want to invest the underwriter's time or energy in a file until it's already in contract. And so what you see, and if you've heard kind of those horror stories about deals falling apart in the 12th hour after a client's in contract and has their deposit on the line and has paid for inspections and appraisals and has money invested. And then at that point, that's when traditionally then the file goes to underwriting. So we do it backwards. We get the client, we review their documentation, we're a technician. I'm like an underwriter, so I know the guidelines. I'm letting the clients know here's exactly what we can do, and then I'm immediately submitting their loan to underwriting even before they find a house, just so one, I can give the client peace of mind, and then two, when they do find a home they love, it allows them to write so much more of a competitive offer.
Wow. And so does the underwriter actually have skin in the game too? I mean, if they say, yes, this is a good loan, and it isn't, do they lose money personally?
They don't lose money personally. I mean, most underwriters, if you've got a good underwriting team, good operations, they want to help you make deals work.
Of course.
But if they're funding loans or approving loans and the loans, can't be purchased because they end up not meeting guidelines, or if the loans end up going bad, right, people start foreclosing, it's tracked. Every underwriter, has their designated number, and if you have loans that can't be purchased or loans that are going bad after the client has closed, that will be reflected poorly on that underwriter, and they probably won't be able to keep their job very long.
I see. So underwriters, they have a certification program too?
Yes.
Or are they licensed? You have to be licensed?
Not licensed, but they have what's called their DE numbers, their direct endorsement numbers through HUD. So in order to underwrite certain types of files, you have to have these certifications, and every file that you touch, your certification, just like a licensed number, is tied to that file.
I see.
And the success of that loan through closing and post-closing is tracked.
I see. So it's tracked both by agencies, but as well as the company and the lenders, etc.
Exactly.
All right.
Yep.
Well, thank you for explaining that, because it's something that I didn't understand myself, so that's why I asked the question. So direct lenders, money comes from a lot of different possible sources.
Yep.
So there's Fannie Mae and Freddie Mac and FHA and VA.
Yep.
And besides those, what others?
Then there's USDA, which is in more rural
the
communities.
agricultural.
Yep.
Department of Agriculture.
Then there's jumbo financing. So jumbo financing is depending on, that has to do with your loan amount and what the county loan limits are for the county that you're purchasing in.
Because some counties, the price of homes is so high, it's above these other loan limits.
Correct.
And so this is a new thing.
Yep. For instance, in Alameda County, the maximum conforming loan limit is $679,650. So once you have a loan amount above that, then you're in the jumbo loan territory.
So conforming is up to a certain amount. That's a term that's used. Conforming loan is.
Yeah. So and it's kind of tricky. So there's two conforming loan limits in Alameda County. So there's the standard conforming, which is $453,100. That's the standard conforming. So that's one pricing tier.
$453,100.
Yes.
Okay.
I wish they could just make it an even easy number.
Right. Well,
throw on the extra $100.
That's to test your memory, and you've got a great memory for these numbers. That's great.
I think so. Yeah. I gotta know them. And then, so that's one pricing tier, and then once you go above the $453,100 up to the $679,650, that's the high balance conforming, or super conforming. So you're still a conforming loan. You could still get a Fannie Mae, Freddie Mac, FHA loan, VA loan, but you're high balance, so it's priced a little bit differently than the standard conforming. So you can have different interest rates based on your.
So it'd be a little more.
Could be a little bit more, yeah. And then once you go above that $679,650, then you're in the jumbo loan arena.
I see. All right. And so that's sort of the direct lender arena. And so there's three different ones. There's direct lender, then the correspondents.
Correspondents.
Yeah.
So what that means is, and this is kind of my favorite niche of it, is so when you're working with a company like us, we have access to all the big box banks, the Wells, Citi, Chase, U.S. Bank, right? All the big guys.
They're called big box.
Big box, the big institutions, right? But keep in mind, they are, for instance, they're a mortgage company like third or fourth on their list, right? Their main focus is they're a depository institution. They're a financial services company. They do investments. They have credit cards. There's so many different hats that they wear in different
ways that they make their money and how they
that they focus on. And mortgage is one of those industries.
Ah, all right.
So for us, mortgage is all we do. It's what we do, and we do it very well. So what we do is on the correspondent lending channel, we underwrite, right? So they'll still go through the same process. The benefit is to the client, we get the big box pricing with the speed and service of a boutique mortgage bank. And so that's the key. So we can get the great pricing that these big box banks have, but we don't have to go through their processes and their timelines.
Which tends to be a lot longer.
Yes. Yeah, and you're not getting underwritten up front, and typically they're 9 to 5 institutions, right? So in this environment that we're in, I feel strongly that a loan officer and a realtor, we're a true partner and a collaborator with the client to help them be successful. A lot of times that means nights and weekends. It means writing offers, sneaking in an offer in the evening before the house goes on the market the next day. I mean, so it's not really a 9-to-5 kind of gig if you're super committed to helping your client do whatever it takes to buy the house that they really want. So
So you offer so much more as far as, not 24/7, but it's like 18/7, or
I get
you need to sleep some.
Real estate doesn't sleep, but I'm okay with that. And my goal is to help the client be successful and to reach the finish line of keys in hand. And when they call me and say, "Oh my God, Monica, we just saw the house. It's perfect. Offers are due in 2 hours, and it's the evening." Great, no problem. Or I need to get pre-approved right now. I just found the perfect house. It's Friday night. Can I give you my documents? I want to write tomorrow. Great, no problem. We want to help people. Of course, it's nice when it's not a mega rush, right? But if it is, and there's a situation, we're here to help.
So that's the correspondent lender. That's when you are working with the big box banks and all.
We still handle the entire process, but we have access to their programs, their rate sheets, and their pricing. So I might be locking the loan with Chase or with Wells Fargo, but I still have control of the process from start to finish. So we can still underwrite fully up front. We still can close in 10 days. We can still waive our loan contingency because we've already done the underwriting. So again, you get the speed and service of a boutique mortgage company that specializes and focuses only on mortgages, and then we have access to the big box pricing, which makes it nice.
Right.